Welcome to Metal Market News. This is Professor Harry, your independent analyst, where we break down the most important developments in the precious metals market with a sharp, no-nonsense analytical perspective. And today we are diving into a potentially game-changing development that could reshape how retail investors interact with silver. Because what we are looking at here is not just a simple product expansion idea. It is the early signal of what could become a structural shift in bullion accessibility and demand dynamics. Now, when we analyze the possibility of fractional silver coins being introduced by the United States Mint, we have to step back and understand that this is not just about minting smaller coins. This is about targeting a completely different segment of the market, one that has historically been underserved due to rising silver prices and increasing entry barriers. And from a high-level analyst perspective, the timing of this discussion is not random. It is happening at a moment where silver prices have been volatile, premiums have expanded, and retail participation is becoming more price-sensitive. Now in the interview referenced featuring Paul Hollis, the mere mention of fractional denominations like 1/10th ounce, quarter ounce, and half-ounce coins may have sounded casual, but in reality, such comments from a figure in that position often reflect internal discussions, or at least exploratory thinking, and historically, when institutions begin floating ideas publicly, it is rarely without groundwork already being laid behind the scenes. Now, from my perspective as an independent analyst, I agree with the core thesis that affordability is becoming a central issue in bullion markets. However, I would challenge the assumption that demand alone guarantees successful adoption, because what truly determines success in bullion products is not just accessibility, but the balance between premium, liquidity, and trust. And while fractional coins increase accessibility, they also introduce higher per-ounce costs, which can discourage more experienced investors who prioritize efficiency over flexibility. So what we are seeing here is a potential bifurcation of the market between entry-level participants and seasoned stackers. And that is a dynamic that must be carefully evaluated rather than blindly celebrated. Moving forward, we must also consider that the American Silver Eagle is already the most dominant bullion coin globally, and any fractional version of it would instantly inherit brand trust, liquidity advantage, and recognition, which could disrupt private mint offerings significantly. But at the same time, I personally believe that simply shrinking the size without innovating the design or addressing premium concerns would be a missed opportunity. Because markets today are driven not just by function, but also by differentiation. And if the mint chooses a conservative path, it may achieve moderate success, but not the transformative impact that many are anticipating. So while the possibility is real and increasingly likely, the execution strategy will ultimately determine whether this becomes a revolution or just another incremental product addition in an already crowded market space. Now, when we analyze the broader context of this development, it becomes clear that the discussion around fractional silver is not happening in isolation, but rather within a larger trend of evolving investor behavior. Because as silver prices rise and remain elevated compared to historical norms, the psychological barrier for entry becomes more pronounced for new participants, and this is exactly where fractional bullion begins to position itself as a strategic solution. Now, the mention of platforms like the Coin Show podcast hosted by Matt Dinger and Mike Nadelman is important, not because of the platform itself, but because it reflects how these ideas are being tested within the community discourse. And when institutional figures engage in such conversations, they are often gauging sentiment as much as they are sharing information. Now, from a high-level analytical standpoint, the key issue I see is the confusion between numismatic pricing and bullion pricing, which was evident in the comments made during the interview. And this is where I must strongly diverge from that narrative, because conflating collectible coin prices with bullion value is a fundamental analytical error. Bullion markets operate on efficiency, liquidity, and metal content, whereas collectible markets operate on rarity, aesthetics, and historical significance. And mixing the two leads to distorted expectations. Now, if fractional coins are introduced primarily as bullion products, then their success will depend on how competitive their premiums are relative to existing options in the private market. And here is where things get interesting, because private mints have already established a strong presence in fractional silver, offering flexibility and variety. But they lack the government backing that gives official coins their added layer of trust. And this is where the Royal Mint becomes a critical benchmark, because it has already successfully introduced fractional versions of its Britannia coins, proving that there is both demand and operational feasibility for such products. However, my analysis suggests that while demand exists, and it is not uniform across all investor types, entry-level buyers may prioritize affordability and smaller ticket sizes. But experienced investors often calculate cost per ounce very carefully, and if premiums rise too high, they will simply avoid fractional products altogether. So the Mint faces a delicate balancing act. It must price these products in a way that attracts new buyers without alienating the core bullion investor base. And in my view, this is where economies of scale could play a decisive role. Because if the Mint produces these coins in large volumes, it could potentially undercut private competitors on premium, creating a competitive advantage that reshapes the entire fractional silver segment. But again, this outcome is not guaranteed. It depends entirely on execution, cost structure, and distribution strategy. So while the narrative is optimistic, a deeper analysis reveals multiple variables that could influence the final outcome in ways that are not immediately obvious now when we move into the structural and legal framework behind this possibility. This is where the discussion becomes even more compelling from an institutional analysis perspective, because one of the most overlooked aspects of this entire conversation is that the authority to produce fractional silver bullion coins already exists within the legislative framework. And this is a critical point that many market participants fail to recognize, because innovation in government-issued bullion is rarely about creating something entirely new. It is often about activating provisions that already exist, but have not yet been fully utilized. And historically speaking, legislation tied to programs such as the State Quarter Initiative has provided the Treasury with flexibility in terms of coin design, denomination, and composition, which means that the pathway to fractional silver issuance is not blocked by regulatory hurdles, but rather dependent on strategic decision-making at the institutional level. Now, from my perspective, this significantly increases the probability of such products being introduced in the future. Because when the legal groundwork is already in place, the barrier to execution is dramatically reduced. However, I would caution against assuming that authorization automatically translates into implementation, because government institutions often move slowly and prioritize stability over innovation. And this is where my analysis slightly diverges from the more optimistic outlook. While I agree that the probability is rising, I believe the timeline could be longer than many expect unless there is a clear economic incentive driving the decision. Now, another critical factor to consider is historical precedent, because the United States Mint has already indirectly engaged in fractional silver distribution through unconventional means, such as the sale of coins with less than 1 ounce of silver content at prices that at times aligned with or even fell below spot price during periods of extreme volatility. And this effectively turned the Mint into a temporary direct-to-consumer bullion distributor, albeit unintentionally. And from an analytical standpoint, this demonstrates that the infrastructure and capability to handle fractional silver products already exists. It is simply a matter of formalizing and scaling it into a structured product line. Now, when we compare this with the historical market for constitutional silver, which consists of pre-1965 coinage with 90% silver content, we see another layer of precedent, because these coins have long served as a form of fractional silver for investors, offering flexibility and divisibility, albeit with lower purity. And this reinforces the idea that the demand for smaller denominations is not new. It has been present for decades. But what is changing now is the potential for official recognition and standardization through modern bullion products. And in my view, this transition from informal to formal fractional silver markets could have significant implications for liquidity, pricing transparency, and investor participation. However, it also introduces new challenges, particularly in terms of managing premiums and ensuring that these products do not cannibalize existing 1-ounce coin sales, which remain the backbone of the bullion market. So while the legal and historical foundation strongly supports the possibility of fractional silver coins, the strategic considerations surrounding their introduction are far more complex than they may initially appear. And this is why a cautious but informed outlook is essential when evaluating this development now, as we move into the broader market implications and investor behavior dynamics. This is where the discussion shifts from possibility to potential impact. Because if fractional silver coins are introduced at scale by the United States Mint, we are not just looking at a new product. We are looking at a shift in how silver is accumulated, traded, and perceived by different segments of the market. And from a high-level analytical standpoint, the most immediate impact would likely be on accessibility, because smaller denominations lower the psychological and financial barrier to entry, allowing a wider range of participants to enter the market, particularly during periods of high silver prices. And this could lead to an expansion of the retail investor base, which in turn could influence demand patterns and price stability. However, from my perspective, this increased accessibility comes with trade-offs that must not be ignored. Because fractional products inherently carry higher premiums on a per-ounce basis, and while new investors may accept this trade-off for the sake of affordability, more experienced investors may view it as inefficient capital allocation. And this divergence in behavior could create a two-tier market structure where fractional coins are primarily used for entry-level accumulation and gifting purposes, while larger denominations remain the preferred choice for serious bullion investors. Now, another important factor to consider is competition, because private mints and dealers have already established a strong foothold in the fractional silver segment, offering a wide range of products with varying designs and packaging options. And the introduction of government-backed fractional coins could disrupt this ecosystem by introducing a new level of trust and standardization. But at the same time, it could also intensify competition, forcing private players to innovate further, or adjust their pricing strategies. And in my analysis, this competitive pressure could ultimately benefit consumers by driving down premiums and increasing product variety. However, it could also lead to consolidation within the industry as smaller players struggle to compete with the scale and authority of a government mint. Now, when we consider the long-term implications, one of the most interesting possibilities is the role that fractional silver could play in a scenario where silver prices rise significantly, potentially reaching levels that make 1-ounce coins less practical for everyday transactions or smaller investments. And in such a scenario, fractional coins could serve as a bridge between investment and utility, providing a more flexible and divisible form of physical silver ownership. And this is where the concept begins to intersect with broader discussions, Arabicate, Arabic-Wow, Arabic-Lam monetary systems, and alternative stores of value. Although I would caution against overextending this narrative, because while silver has historically played a monetary role, modern markets are driven by a complex interplay of factors that go far beyond physical metal ownership. So while the introduction of fractional silver coins could enhance accessibility and flexibility, it is unlikely to fundamentally alter the role of silver in the global financial system, at least in the near term. And this is where my analysis remains grounded, acknowledging the potential while also recognizing the limitations now as we bring this analysis toward a conclusion. It is important to step back and evaluate the overall significance of this development from a strategic and market perspective. Because while the idea of fractional silver coins being introduced by the United States Mint is certainly compelling, It is not a guaranteed Arabecta arabicete arabiquao arabiclam, but rather a Arabecalif arabicete arabictas arabiclam that depends on multiple converging factors including pricing dynamics, production strategy, market demand, and institutional priorities. And from my standpoint as Professor Harry, I see this as a logical evolution in the bullion market, driven by the need to adapt to changing economic conditions and investor behavior. But I also see it as a move that must be executed with precision. Because the margin for error in bullion products is relatively small, and missteps in pricing or positioning could limit adoption and reduce the overall impact. Now, when I compare this situation to historical precedents and current market trends, I find myself cautiously optimistic. I agree with the broader thesis that fractional silver has a role to play in the future of the market, particularly in expanding accessibility and attracting new participants. But I also maintain that its success will depend on how well it aligns with the core principles of bullion investing, namely efficiency, liquidity, and trust. And if these principles are compromised, even the strongest brand recognition may not be enough to ensure long-term success. So as we move forward, this is a development that deserves close attention, not just for what it represents today, but for what it could signal about the future direction of the precious metals market. And whether or not this potential revolution materializes, one thing is certain: the conversation itself reflects a market that is evolving, adapting, and preparing for new realities. And that in itself is a signal that no serious investor should ignore.